What should banks or people be thinking about when they look to create a product in this industry?
So in my experience, I think product development, specifically in the liquidity space, but could be kind of a guideline for any kind of product development, is
Yeah.
creative discipline and creativity so that you're getting the innovation to achieve whatever your defined goals are, while also being sensitive to that qualified data that we just spoke of.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of treasury, liquidity, and risk. Join us as we power up the liquidity conversation.
Hello, everyone, and welcome to our latest installment of Liquidity Talks live stream and podcast. My name is Neville Roberts. I'm the CEO and founder of Planix, the market-leading fintech focused on treasury, liquidity, and risk. Now, our topic today is entitled How to Create Products Using Data to Enhance Liquidity Management. Welcome to our audience today. Good morning, afternoon, evening, wherever you may be. A big thank you to all of our audience. I'd like to say up front, our numbers are growing by about 2x every podcast. I'm going to put that down to our topics and our guest speakers rather than anything else. But anyone can ask a question as we run through. If you put it in the comments section you see on the right-hand side of your screen, and I can take any of these as we go, and I can also answer any at the end or after the podcast as well. If you ask a question, please let us know who you are, and if you can, your role, so we can put it into some form of context. Now, a few weeks ago, I asked if anyone in the audience would like to join a podcast, and I'm absolutely delighted to be joined today by our guest speaker who has asked to join, and that's Tom Meiman, who spent most of his career at BNY Mellon in this very space we're going to talk about. So an exceptional depth and breadth of knowledge and experience. So welcome, Tom. Would you like to start by introducing yourself, telling us who you are and what you do?
Thank you. First of all, it's great to be with you today, Neville, and I appreciate the opportunity to speak with you and to speak on this topic with all those who are taking time out of their day to listen. My background is in payments, largely payments product management. I've managed a number of different product solutions across different rails. Had different types of responsibilities in this space over the years. And the last, probably 10, 12 years of my career was spent adding a product discipline to operating liquidity, or the funds that banks and clients need to meet business needs from one day to the next.
Perfect. Now, I normally spend a minute on football right now, Tom, but I know it's not your sport, but I did notice that not far from you, Liverpool and my team are going to be playing at the Steelers ground on July the 26th. So who knows, I might actually see you in person then at that event. But I guess your sports are baseball, a bit of ice hockey, sports like that. Is that right?
That is correct, but I mean Pittsburgh does have a pro soccer team. The
Yeah.
Riverhounds get a little shout here, but if you make it over from the UK to see Liverpool at Acrisure Stadium, by all means, we'll be in touch.
Definitely, definitely. Right. So this episode, we're going to talk today about how to accurately forecast cash supply and demand throughout the day. We're going to understand how to create products that align efficiently to characteristics of transactions, and also understand client relationships and how important they are. So, Tom, a lot of juicy questions today. So I think starting off, question one, which we always do on these podcasts, is let's just take a step back, go back to basics, and explain what you mean by a product or a solution.
Sure. In the liquidity space specifically, a product or solution could be a whole lot of different things. I would generally categorize them in kind of three different areas. There are on-balance sheet product solutions, there are off-balance sheet solutions, and then there are tools or plumbing, as our colleague Olaf likes to refer to it, that moves funds back and forth. So on-balance sheet could be a transaction account of some sort, a current account or demand. Anything that's on the balance sheet of the financial institution that's providing the service could be interest bearing or non-interest bearing, could be a hybrid of those things, could be in any kind of a currency too. I mean, so wherever those accounts are supporting business globally, um, could be a virtual account, which I'll describe very quickly as a subledger capability. So the bank provider will see one account and one balance. The client sees a subledger capability, so they can parse that balance into as many ways as they need. Um, on the off-balance sheet side, there's investments in funds or securities or repo,
Yeah.
and those are more near cash type items, but can be quickly moved to support needs there. And then there's other tools that are out there. So there are sweep mechanisms that can be done actively, passively, depending on the solution setup and the needs of the client. There's
Yep.
There are netting and pooling solutions where they are permitted to help manage cash positions. There's dynamic allocation tools that, based on criteria, parameters, et cetera, they will take some action, whether that's moving funds or pushing notification, that kind of thing. Those are all different products. So kind of a summary of that is that a product or solution or service is something offered by a financial institution that the client can use to meet their specific needs. And
Yeah.
it's also going to be helpful for the bank to provide for their needs.
No, I get it. I mean, that's a pretty broad range, right? I mean, recent events have highlighted, products, mainly deposits, more so the outflow. Um, uh, Love to hear your thoughts on this. And was it a deficiency in the offering or the product that created those recent events a year ago, or other things?
It's a good question, and I think it's something we're all challenged to reflect on. I don't have any specific intel on any of those failures, but a couple things are very clear. If your financial institution and your balance sheet is overweighted, not that having some of these deposits is a bad thing, but if you're overweighted in things like uninsured retail balances or excess or non-operational wholesale balances, and that's without regard to whether you have the backing of high quality liquid assets for them or HQLA. If you're overweighted in those deposits, that is a recipe for trouble. I think the other point to note here is that the products and services that were used by the industry to move funds in and out of financial institutions, they work extremely well, and
Yeah.
arguably too well. But if there was a deficiency here, it's with the oversight of the balance sheet concentration risk rather than with the product. So if a given bank had been tracking specific data elements, such as the ratio of uninsured deposits to total deposits, I think they would have seen some things, especially if they were modeling the metric for risk management. They would have been prompted to greatly diversify their deposit balances.
No, I've got it. And I think we've talked in previous podcasts as well about the role that social media played in that, because you could get
Mhm.
everything right, but ultimately the social media play on this meant things happened so much quicker in
Yes.
time. And we obviously saw that play out. Now you said something in what you said last about that was key, which was around, if a firm was tracking specific elements. Do you think tracking in real time these days, it's a necessity? It's a response to isolated events. How important is that?
My opinion on that um, is that tracking in real time, specifically tracking deposit balance and liquidity positions in real time, if it's not a necessity now, it will be soon. It's also not completely a new concept, especially for larger organizations that are servicing large global players or financial institutions. The recent events show some downside case studies, but those alone aren't aren't enough necessarily to say, yeah, I have to go and do this. When you look at the total volume of payments,
Yeah.
particularly in the States, if you look at the Fed's payment study, you're going to see 200 billion non-cash payments in a year. And the immediate payment volume is about 300 million currently. It's growing, but it's in comparative, it's less than 0.2%. So that in and of itself as a concentration is not going to drive you, but 300 million of these payments that are immediate, final, and the average face value is getting up there, they can have a material impact. So tracking liquidity in real time is essential to knowing now what is normal activity. So once you know what's normal, you can track the markers for what is outside of normal. And the industry's doing a lot of good things in this space. They're learning every day in this space, having good access to data that is tailored for purpose, such as these current available balance trends. I think those are going to be critical for effective business decisions, whether they're done in AI or done by humans.
Yeah, look, we hear from customers and prospects all the time that the world 5 years ago it's moved from intraday to real time. It's so critical. Something that I wanted to pick on, you said you mentioned tailored for purpose comment, and I just wanted if you want to expand a little bit on that.
Yeah, by that I mean data that is qualified to meet the defined situation. So every organization has data coming out their ears. I mean, there's no shortage of data. And the point that I'd like to clarify there in the tailored for purpose is filtering through all of the voluminous data that you have, and whether it's in your warehouse or your data lake or whatever you define your repository as, and identify and qualify that data so that it can be deployed for whatever the situation is that's suited for purpose at hand. I mean, as an example, a prior day closing balance or the opening balance from current day, that's stale data if your business and your bank have been open for any period of time. And it's more exacerbated by the fact that you could have payments being presented or requests for payment being presented across multiple rails. And, are those payments complete? Are they final? Are they pending? Do you know all of that? And critical to the evolving payments environment is not just knowing adequacy, but knowing the actual account balance when that transaction's executed. And once you have that data, it's a stepping off point for even richer activity. So once you have that, now you can incorporate it into your forecasting processes.
I get it. So it's clean data, it is quality, it's got to be in real time, but you could do all of that. You've got to turn it into the right insight, right?
Yeah.
Okay, great. Look, changing focus back to product. What should banks or people be thinking about when they look to create a product in this industry?
So in my experience, I think product development, specifically in the liquidity space, but could be kind of a guideline for any kind of product development, is creative discipline and creativity so that you're getting the innovation to achieve whatever your defined goals are, while also being sensitive to that qualified data that we just spoke of. So if you're a fast follower and you're looking at your competitors and they've got a solution that you don't have, that's not necessarily a gap. If your target client base can't use it or won't use it, or use it to that same level. So I think product development should consider the following key things. First of all, answer the question, does this product or solution, will it support your overall business strategy? Will it enhance your service delivery? Will it improve your regulatory compliance processes? Will it drive the target financial return? That's the big one. And in order to do and answer all of those questions, you need a strategic assessment. You need to know how your organization's strengths and weaknesses measure up against the opportunities and threats of the industry. So that's a SWOT analysis. And you need your business plan well documented. And both of those need to be revisited frequently as you go through the development process. That's first. I think secondly,
Yeah.
you need to be candid with what the data is telling you. And that includes a market analysis. So if you haven't undertaken a market analysis, you need one to tell you how big is that market, what's driving that demand in that market, and what's the outlook for that demand near term and long term, and how long is it going to take you to develop. As an example, if you're targeting specific growth in your balance sheet, perhaps it's an increase in your lending portfolio, and your deposit liabilities are from an accounting perspective, your liabilities fund your assets. So if your outlook for lending is you want to develop this much lending and you're going to get this kind of a rate on that, that's going to help you to identify and source your deposits that are going to fuel those loans. Another point to consider, I think, are any products that have maybe passed their time, worthy of de-emphasis or discontinuation, maybe even full retirement, to preserve the resources that you need to develop new solutions. And then really important here is to thoughtfully engage all your stakeholders, whether they're internal or external. You need a voice of the client, for that
I've got
development
it. And have you found, Tom, over the years that products that tend to hang around for too long, so they've been stale or not relevant anymore, and they've just lingered on? Is that your
I
experience?
think every organization is going to have something that, if you're tracking the data on it, you're going to see that its usage has gone by.
Yeah.
And maybe you're fortunate and you're vigilant about that. But if you're not, that's a good practice, a good discipline to take on the
Sure.
product development front.
Now, I mentioned client relationships, which is part of this podcast. They sound critical in this creation of products.
They're absolutely critical. I mean, you need the input from your clients to help understand the usage and the potential challenge. You need to understand their pain points, and those relationships can span multiple parts of an organization. And depending on how integrated your organization is and how complex or how siloed they are, you need to be able to look at the relationship as the client will look at it. And I think that relationship isn't going to be complete without considering all of the different services they're using within your service offering, as well as the other areas of your organization. And that view isn't complete without including all of the response or return on the liquidity and the deposit balances. So the balances in one part of a financial institution, for example, may be encumbered for purposes that you may not see. So in my world, if I was in payments, I could see that there was a balance someplace else, but I may not know whether that balance was free or encumbered. And so having that view is important to know and to document so that you're able to ascribe value to it, and know whether it is available for other purposes. And ultimately, the return on all those balances from the client should be documented and included in any profitability analysis.
Yeah, and look, Tom, it's the same in the software world, right? We've built our software with banks for banks. So rather than think we have the right answers, you speak to clients, prospects, the industry, work out what they want, and then you build that, because that's probably the best answer you can do. But I mean, what about internal relationships as well? So you could argue that they're just as important, if not more important.
You can make that argument, and I wouldn't disagree with it. I think it's going to be up to each organization to determine that. But I think, especially in matters of payments, it's really important that internal stakeholders are able to see the total value that they are including in their assessment for their responsibility, the value that a portfolio of clients is generating. And that portfolio of clients includes their portfolio of balances and liquidity. If you look at the financial statements of different providers who are in the payment space, you're going to see that this business is typically profitable only when you include the return on the liquidity, the deposits on the balance sheet, the investments that are related to this activity. And I think one way to foster that transparency is frequent portfolio reviews that include all of these different stakeholders. Because I mean, it's going to cost you a lot of energy, you're going to burn a lot of calories getting people to understand the value if it's not transparent to them. So I think that's an important concern to address with the internal folks.
Got it. Look, so we've spoken about creating products. Do you see opportunities in having access to data in real time for them? So if I'm a cynic, I'd probably say, well, look, if I've got all of the data in a transaction, what does real time add? But I guess your point is, yes, there's value to having it in real time.
There absolutely is, and I would say your cynical approach is very accurate and spot on. You do have the data, and financial institutions have had this transaction data for some time. I think the real question is, were they using that data for more than just transaction posting and perhaps some other data mining? Were they using that for monitoring real-time positions? Does that financial institution that has the data actually have the means to tap into the depth of that information? So you may have had the transaction data for some time, but are you tracking the balance sheet portfolio in real time or close to real time, as opposed to the batch process that is the history of so much of payments? I think regardless of how that tracking is going to get done, maintaining balance sheet data throughout the day it could be an unfamiliar process for a lot of these practitioners, and it needs to be managed so that not just for the immediate payments development, but for broader mainstream use of the organization's data pool. So start with the real-time data, adding a continuous view of the balance sheet throughout the day. So if you're not doing that, get to that point. That presents the basis to indicate that balance sheet health and potentially identify funding risks, vulnerabilities, et cetera, and compare them. You may also find funding opportunities where you've got trapped or stranded liquidity pools. But I think either way, I think the immediate payments as a model is a good funds model, and that's going to promote some healthier liquidity practices and activity.
Yeah, and look, Tom, we've seen that transformation in what we do too. So years ago, it was the overnight batch process, and that's probably true in most industries as well. Then it became intraday. So let's run the batch process a couple of times a day and get an update throughout the day. But it really is now in the area, in the realms of real time. Let's get data and information now, and it's constant throughout the day, and you get that precision and accuracy all the time. I've left this question towards the end, but what does all of that, all those products and all that mean and help with liquidity management?
Well, what I would say is that generating a real-time view on liquidity, and that's, for example, the broad perspective of the provider all the way down to the liquidity in a given account or for a given client, and then every segment in between. That's the basis for more precise liquidity management, which is going to drive more optimal business management. So, I mean, we're seeing immediate payments growing, seeing intraday activity. Clients are learning the funding requirements that support the different payment rails and seeing contrasts between immediate payments and other payment rails. And as they see that, they're going to evolve their payments activity. Providers are also seeing the balance sheet impacts evolving over time. I mean, there have been a lot of great controls in place. I think the pace of payments movement in real time has been controlled and tempered by some of the controls. And I think that was prudent for the industry. So kudos there. I think regulators also are going to learn to refine their tools and their demands for reporting over time. And that's also going to feed into just the general need for a real-time view.
Got it. And Tom, you've been in this industry, in this space for a number of years, but how have you in general seen things change over the years you've been involved in these liquidity products?
I would say the biggest change is the introduction of control and rigor through Basel. Specifically,
exactly.
The introduction of liquidity coverage ratio, net stable funding ratio, and the risk monitoring tools that came along with that. These are specifically designed and promoted for internationally active financial institutions. But I think these principles are not just applicable, but important for all financial institutions to practice some sort of discipline around the liquidity levels that they're maintaining, and whatever is deemed prudent, not just by themselves, but by a third party. I think it's important to have that view, and I think that's probably the biggest introduction and the biggest change to liquidity products. The structure that's out there is going to continue to evolve. It's not perfect. It's a foundation with building blocks for minimum controls, and I think minimal controls are better than maximal controls, and allow them to evolve over time.
Sure, and I presume you've seen technology play an important role over those years in evolving these products and how they're presented to clients and how they're used.
Yeah, absolutely. I would say that things like standardization, the ISO 20022 standard, has been a real important introduction for streamlining the exchange of payments. Distributed ledger capabilities are a big item, and initially distributed ledger was a solution in search of a challenge, and I think cash management, treasury management is a big example there. It's been a great help, I think, in the trade finance space. I think it's becoming more applicable in deposit management globally. JP Morgan has just introduced something on that space. So I think it's an evolving solution. And then, AI is still evolving and is going to continue to evolve over time. And it's, a lot of caution is out there in this space, and it's rightfully done. I think it's really important to make sure that you understand where you're deploying it. And I think everybody does need to use it and learn about its capabilities. If you're looking for the means to refine how a message is sent, that's one thing. You don't need current data to refine your prose. But if you're looking for something that's going to be responsive to more recent intel, you need to be cognizant of the training data on that application.
Absolutely. And Tom, I can't help but ask towards the end, you've only got a few minutes left. Given your length of service in the industry and as a youngster like me, I'm sure you've got lots of war stories out there. And if you can, and without giving anything confidential away, what's your top one or two kind of war stories that you could tell us about?
Well, I would consider, and I'll leave the kind of the biggest, ugliest ones out, but the introduction
of that, right?
Yeah, I mean, we'll have a discussion on those if you come to Pittsburgh in July. But negative rates on currencies, when that was introduced, that was a bit of a shocker from a product management perspective. I mean, and how different central banks were administering that. First of all, it was a matter of understanding what does it mean, and then once you understand what it means, it was an exercise around what is your capability? What's your system capability? And making sure that your systems could handle a negative interest rate.
Yeah.
And then once you've solved for that, because you had to solve for it if you weren't spot on already, then the process of spinning a product into the environment of, here, I'm going to charge you for holding balances.
Yeah.
That was a bit of art form, and I would contrast that with, from the time earlier in my career when there were extraordinarily high central bank rates.
Yeah. Remember them?
And from super high to negative, what is, we hear conversations about returning to normal. What's normal? And I would caution folks to not look at returning to normal, but what is the expected rate environment? I mean, interest rates are not like water. They don't seek their own level. Interest rates are going to respond to market influences, and you need to plan for where those are going in the future. And just because it's been a long time since interest rates might have been above 10%, doesn't mean that it can't happen. And you need to not look at what is normal versus you need to look at what is likely to happen.
It's a little bit like the negative oil prices in, I think it was 2020. How could that be? How did it work? And I'm sure a lot of systems couldn't cope with that. But one last question, Tommy. Yeah, if you've got one takeaway for the audience today, what would it be?
I would say it's manage your transaction data, taking advantage of those real-time perspectives and capabilities that is there, and use that data to track and manage your balance sheet. Use it to adapt your product suite. Use it to improve your risk management protocols. I mean, we mentioned earlier that you've got the data. You need to find a way to manage it and to use it. So that would be my takeaway.
Got it. Perfect, Tom. I think we got a couple of questions through on other platforms, so we'll probably answer them afterwards. But unfortunately, Tom, we've run out of time. Thanks for joining us today and sharing your views. That concludes our latest Liquidity Talks live stream and podcast. We'll put the podcast on LinkedIn, Spotify, Apple Music, and other media outlets as we normally do, and streaming services very soon. Thank you very much for joining. Look out for our next podcast in June when we have someone in a very senior role from a major US bank joining us. Going to be a cracker, so follow us on socials to see who that is. My name's Neville Roberts. Thank you for tuning in, and goodbye.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of treasury, liquidity and risk.